All right. So good morning, everyone. And we're going to go ahead and get started. We have a lot of content and we're really excited about this session because we're going to actually have you work through a case study. Hopefully you all got that yesterday. I sent that yesterday evening. And I want to thank Fannie Mae for sponsoring this webinar. I also want to thank Marie for also putting this fabulous part one, part two webinar together. And so without further ado, Marie, I'm going to pass it off to you. Thank you.
Oh, well, thank you, Vicki. And I'm looking at the chat area and seeing that Stephanie's with me on Watermelon Sugar. So that's cool. I got a confirmation that was the right song for me this morning. But then, we're definitely looking at some really fun songs moving forward. So hopefully we get to see those next month. But yeah, to just jump right into it, we had a two-part series where we were talking about essentially, what are we doing with our homeowners as they adapt to the current crisis that's still affecting so many. When we had conversations with the different lenders, one of the things they just really wanted to stress was making sure we're communicating with our homeowners about the COVID-19 forbearance options that are available, and then what it means for them in the long run. So I want to make sure that that's kind of where we hit home today. And so just to kind of revisit our webinar from last month, it was literally a year to the month that we started experiencing all of this, financial shock, whether that's personally, professionally, or spiritually, just not being able to be around family and friends. We saw that it affected our clients in our own families in such a way that we had all the feels, right? So guilt, frustration, anger, these are all the things that existed because there was so much unknown when it comes to the pandemic, just the virus itself, let alone how it was going to affect the economy. And so, yeah, use the chat area or you can hand raise or talk about real quick some of the things that you all did, in terms of adjusting, right? So if there was a certain thing that you had to cancel, what was it? Put it in the chat area. It'd be neat to kind of see what we all had to kind of learn to live without, I think, or things that we realized we didn't need anymore, right? The pandemic, it surely allowed everyone to kind of reevaluate, gave us the space to reevaluate our finances. And so, we have had to look at budget versus crisis budgeting and the difference. And we talked a lot about that last time, so I'm not going to go too heavy into it. But certainly as practitioners, you all started seeking out all the different national, local, tribal government programs that are available to assist your clients. You went to look at hardships were hardship adjustments that were available through the credit card companies. A lot of them allowed for non-payment for several months in that beginning stage as well. I think for me, the part that I'm most concerned about is that maybe those elements were taken advantage of and then weren't applied to how do we move forward. Now that you're not making your payment, what are you doing with that extra income, right? And that follow-up, did they actually do some of the things they said they would do? Also a plan. We'll talk a little bit about the stimulus check and whether or not they actually have a plan for that money, and they are going to choose to do and bring themselves out of the financial crisis that they might be in, utilizing both the stimulus and forbearance, for example. So financial health is mental health, right? And so that idea, we talked about it, but here's the crisis budget checklist, right? So this is what you would really want to make sure you're doing with your clients, but specifically your homeowners, because I think for many of us, once they become homeowners, we're done, right? We've accomplished that goal. You might have a post-purchase where you're talking about insurance and seasonal maintenance and things of that nature. But I really do think that, in this case, did they have a plan for the new income sources, right? So the stimulus check, the mortgage relief, are they making household commitments? So I'm a big believer in writing things down. And so they have to commit to living on the new adjusted income level, right? The habits are such a thing that you will rely on and do what you've always done. And so committing on the new level means that they're not going to, revert back to their old ways of maybe spending more than they have at this point. Committing to not incurring any new debts. So certainly with their stimulus check, they may think it might be a good idea to put a down payment on a new car, but what is that debt going to have? What impact is that going to have in the long run? And then evaluating to eliminate, right? So what do I mean by that? Well, there's a line to every income, in which case housing, food, transportation, and medical expenses are usually that line, right? That's really what you want to commit to having and putting away for. However, those flexible and non-essentials like entertainment, certainly, anything, hair or makeup related, vacations, aesthetics, things that we used to do that we might not be able to do anymore. And I also think, again, going back to habits, rethinking or delaying annual activities. I mean, it's second nature for me to maybe purchase school supplies or school clothes in August, right? But do they really need it? They're on virtual now. It's a different dynamic. Giving gifts, your clients may automatically say that now that they're not seeing as many family members, they may not purchase as many gifts, or they might think about doing an e-gift for $20, where if they were to see them in person, they would have spent so much more. And then I really want to talk about analyzing monthly subscriptions, because I think the benefits of the pandemic is that we all got used to utilizing things like Amazon and other, one-click type payments through their apps. However, it's so easy to then have so many subscriptions. You don't know how much money is flying through the accounts. And so, it's important that we're revisiting that. And so I kind of flipped the script on what we're discussing. So in the last training, we talked about refinancing before forbearance. And I really think that the crisis budgeting and the forbearance option kind of go hand in hand in that, this was meant to provide relief to our homeowners. And so essentially it was just the payments were suspended or can be suspended for up to 6 months of relief. And so, of course, I'll explain how, but this suspension can actually go for an additional 6 months for a total of time where the homeowners are not having to make those payments. So the thing about it is they have to go to their loan servicers for that. The client has to go ahead and collect and let them know that they're getting that information about what COVID has done or what sort of impact COVID has had on them. And so the loan servicers is where they need to go to get that, not the loan provider, right? So at the end of the presentation, I'll show you a lookup where they can go ahead and find that information out to find out where their loan servicers are, and if it's backed by Fannie or Freddie Mac. But, the forbearance agreement itself, it is a suspension of the loans. A lot of time we talk about forbearance and we're talking about, most people are familiar with school loan forbearance, in which case they're not paying for a certain period of time. Maybe they just graduated, and so they're given a forbearance. With homeownership, it's a little different, right? Back in 2008, when things got a little crazy with the housing market, the option of forbearance became more prevalent, and people started using that in an effort to kind of curb foreclosures. But it's important to know that it doesn't cover taxes, insurance, HOA fees, escrow from their escrow account. So how do you request this forbearance? You have to submit a request to the servicer, as I mentioned before, but then you also have to just affirm that there was financial hardship. Going back to the example of the school loans, normally when you get a forbearance, you have to show some sort of proof, whether that's through an income hardship or if it's going to be an income-driven repayment. They want to see your documentation. With this, you're just simply affirming that there was some sort of financial hardship due to COVID-19. So that could mean that you yourself had it and had a reduction of hours, or it could mean that a family member had it, or maybe that you're no longer working because you're staying home with the kids. So there's a million different reasons how or why COVID has affected your family. The caveat is you have to make sure that you've connected with the servicers to let them know that. And that's one thing, as I spoke with First Tribal Lending and Dark Feather and Chetta, she really wanted to stress the fact that she's not seeing homeowners connect with them to let them know what's going on. And that's really what they want. No one wants to see them get to a place or space where they're having to go through loss mitigation, which is a much more complicated process and requires much more in terms of documentation. So no one wants them to get to the loss mitigation stage. So they definitely want them to take advantage of forbearance, but there are some other things to note. So The servicer will suspend the reporting of the delinquencies. So even though you're not making your payments, they will not report it to the credit bureaus. But what you do have to know is that if you are current before the request, well, then the creditor is going to continue to report that you're current. However, if you are delinquent, then they're in a sticky situation because they're already reporting you as negative. And even though you're not making your payments, they can continue to report that you're negative. So what do we suggest? That they do whatever they can, the homeowner do whatever they can to at least become current before going into forbearance. And so take a look at this slide or reference it later, because obviously the servicer responsibilities is where we received the guidance. This was February 19th, Dear Tribal Lender letter. And obviously it's a lot of information, but this is where the lenders got the majority of the information as it relates to, their commitment to homeowners. I think the only thing I really want to highlight here is the fact that, they can extend I'm moving this out of the way. They can extend the forbearance start date through June 30th, 2021, meaning if a homeowner has had some sort of impact, financial hardship due to COVID as of last week, they would be able to apply for forbearance as a result. So keep that in mind, that it's not never ending, and that the servicers and their responsibility to educate their clients still apply. I think most of our clients just don't communicate with the servicers, and that's really where we want to make sure that they know that the first step is to contact their lender and their servicer, make sure that they know and they review their current loan amount to determine whether repayment is an option, a partial claim. So Darkfeather mentioned the fact that if they're currently delinquent and they, communicate what's going on, whether it's COVID related or not, they should communicate with their lenders so that they can look into the partial claim option as well. So if a family has a delinquency of, let's say their payment is $1,000 and they're late four payments, that's $4,000. They could request a partial claim. HUD is allowing for them to go ahead and create a separate loan for $4,000, and that way they could commence making the payments, starting fresh with the client. And then, of course, there's loss mitigation, but again, that's a lengthy process and one that we want to be concerned about because we don't want people to have to go that route. So again, the loan lookup is here to see if their loan qualifies for the forbearance option. Certainly the private mortgage providers take their guidance from what the federal organizations are doing. And so in a way, they have similar programs, but they may not function exactly the same. And so the only other thing I would say is I'm going to provide you with that Dear Tribal Lender letter. And so that way you'll have that body of information as well. Obviously with this presentation, I can only put so much and there's a lot to go over. So you want to look at that. So now going into refinance, what about those clients that maybe didn't have a financial impact due to COVID, but they've been able to make their payments, but they are struggling, right? And so they just need to figure out what their options are. Well, we talk a lot about homeownership in terms of building assets. And so how do you unlock equity, for example? I think these are the kind of conversations we need to start to have with our homeowners, because depending on the types of markets that we're seeing, it may be beneficial for them to sell, but there's other elements to this as well. So of course, refinancing just replaces your current home loan with a new one. But you have to, navigate as to why, like what is the purpose of getting a refinance? Is it to lower your monthly payments or maybe shorten the life of your loan? Can you afford closing costs and fees, right? So it's just essentially another loan, and it will have some fees associated with it. So that's your checklist in terms of what clients would need to review and think about in order to move forward. For example, if someone was furloughed from their position, that may have an impact on whether or not they're able to refinance. Because in the case of Section 184, there are some requirements such as, consecutive payment or employment verification. So when and why should you refinance? This is a little, just a cheat sheet. Certainly reducing monthly payments, tapping into equity, paying off the loan quicker, so you can go from a 30-year mortgage to 15 perhaps, or of course the removal of private mortgage insurance. Section 184 has three loan refinancing types. So there's no cash out, and streamline. And again, in an effort to save time, obviously I took out some of the elements that exist within each of those options. However, I'm going to also provide you with the document that goes over all the details, because there's just so many other caveats to this, whether you're on or off reservation. So the no cash out option, essentially, as it relates to either reducing your interest rate or reducing your term of your loan. This is for someone who doesn't necessarily doesn't have a Section 184 loan, and they'd like to refinance into one. So borrowers must credit qualify to be eligible for this type of transaction, and there is a max loan amount. So if you own your home outright, let's say you owned a home that was worth 200,000, then they would only allow you to take out 98% of that, essentially. However, again, the acceptable payment history of 12 consecutive monthly payments still exists. So you have to have been doing well and making your payments on time. Cash out is another option for homeowners needing to tap into their equity. And so the property must have been owned by the borrower for at least 12 months. And that maximum loan amount is 85%. I mean, the thing about maximum loan amounts is simply that they don't feel, no lender really wants you to go and max out your entire equity within your home. So most lenders have some sort of maximum loan amount when it comes to refinancing. So this isn't specific to 184 in that way. Payments to third-party creditors are required to be paid in full and account closed. So one of the things to note is that they're not going to give you the funds and allow you to make to decide, how and when you'll make those payments. If you're wanting to pay off credit cards or car notes or anything like that, you'd have to provide them with that documentation, and then they would pay the account in full and then close the account. So, this is, again, one of those things in talking with our clients, maybe they only have one credit card and it's the only way they've been able to establish credit. Well, then closing the account may have a negative impact. And so, these are the kind of things you just want to discuss and make them aware of it. Even though it might in the long run benefit them in terms of becoming more financially sound. And then the max cash, I think this is the biggest thing for me, the max cash to borrowers, meaning the amount that can be provided at closing to the loan, to the homeowner, is $25,000. So even if they have an appraised value and an equity of $50,000, they'd only be able to take out $25,000 in cash. And then they do have to disclose what their plans are for that money as well. And then lastly, there's Streamline. So if you took out a Section 184 loan 6 years ago, obviously interest rates are a lot lower. So you might want to go from 184 to 184. So that's the other name it goes by. But the neat thing about this one is that it allows you to do the same thing in terms of reducing your interest rate or your term of your loan, but no appraisal is necessary. And so that's helpful in case you don't have as much equity as other individuals. And there's no income or asset verification. So that's another element. Normally with appraisals, you'll have a fee associated. So it's nice that there's no fee. You must have the same in terms of the verification. So you must have your mortgage payment on time for 12 months. That's the same as all the other programs. But there is a verification of employment that I want to stress because, again, going back to furloughed individuals, it's kind of a rock and a hard place when, you need the help, but you don't have that consistency in terms of employment. So with the no cash out and cash out options, the big takeaway there is that the new appraisal is necessary, and that is at a cost to the borrower. So, there are other things that obviously with the time constraint and wanting to get you all to case studies, I definitely felt like there are other things you need to know of, like with the appraisal, you want to make sure that you can afford those fees. And so really reference that document. But now we're going to jump into the case studies. I want you to be able to apply what we've discussed. And certainly if you have questions, when Vicki puts you into the breakout rooms, essentially what will happen is you're going to go into your breakout rooms, read the case studies. She's also going to send you a checklist, a cheat sheet, So via email, you should have something that'll help you kind of go through all of the details as I've discussed them. So that should help you answer and discuss questions. But Vicki, I guess if there's any other questions, I'll be popping into those break rooms at times just to kind of see where the discussions are going and answer any questions that you have.
Wonderful, Marie. So I have 3 breakout rooms, and I just sent you all an email that has the case study and the checklist tool to use. And we would say during this time, we'll have you in the room for about 15 minutes and for you to just pick one of the case studies. There's 2 of them, so pick one of them. All right, I'm going to release you all into the rooms for about 15 minutes.
We'll see you soon.
Did everybody go in there? Let's see. Let me pause this. Wait. Welcome back, everyone. I think everyone's back. I'm resuming. Okay.
Amanda.
Okay, so we're going to have some discussion here about our 2 case studies. And I guess, Vicki, are we going with group 1? Oh,
yeah. Group 1 was Elaine, Kelsey, and Stephanie.
Okay, great.
Huh? Sorry.
Go ahead, Stephanie. You can go ahead and discuss your which case study you chose and some of the, I guess we can go over questions, the first couple questions, and then allow to see if anyone else has chose that same case study and wants to comment.
Okay, so we chose case study number 2. Miss Chaos worked for an educational department that remained open during the pandemic. She made her payments for 12 months. She ended up having her sister and 3 nephews move back in with her, and she wanted to expand her home. But she, hold on. She does have equity in her home, and she wanted to see how about unlocking the equity without selling it. So the first question is discuss the options available to Miss Chaos. It would kind of stop right there because I would, as a person that, I would want to know her income to debt ratio, her credit score, her budget to see what she could possibly be eligible for. I would probably say it would be the Section 184 cash, the cash out, where she can get up to 85% of her appraised value of her home, because she does have equity in her home, as her home valued for $200,000 and she owed 120. So what I would really probably stress on is what her budget was looking like and what her debt to income was.
No, that's great. Yeah, we definitely want to make sure she financially can support the anticipation of pulling that money out, and that she doesn't have too many credit cards or other things that could hinder her debt to income, right? Because it still has to be 41% or lower. So the other Section 184 requirements still apply. And you're right in terms of checking the cash out option for her, because this is the only one that allows for her to take some of that money out and maybe put it towards credit cards. So did group 2 select Miss Chaos? Thank you, Stephanie.
Group 2 was Andy, Haley, and Nicole.
So group 2, do we have a speaker? No one was voluntold? Okay,
all right.
I'm gonna pick on Andy.
We did case study 1.
Okay, great.
Mr. and Mrs. Mayhem, both in reduction of their monthly income. Of course, you can read it all, but the first question was, what is the steps? What is the first step the Mayhem should take? And obviously, we're talking about getting a hold of their lender because they are 3 months behind on their mortgage, okay? And sitting down and talking to them regarding this. In order to go to forbearance or anything, they need to catch up on that arrearages on their mortgage, which is 3 months behind, 29.25. That needs to be paid off before. The good thing is they didn't cash any of their stimulus checks. They've been sitting on them and holding them. So I would take those stimulus checks and start applying them towards that arrearages in the mortgage so they can go into forbearance. Next thing is prioritizing the expenses and everything. Of course, we said the mortgage, catching back up, the car payment, car expenses. They have 2 vehicles, they're only making a payment on one. And we talked about the insurance aspect of it all, cutting back on the insurance. If you're only using one car, then cut back to try to save as much, because it's full cover for both vehicles. Credit cards.
Exactly.
We were kind of playing with either paying off the false mark, since it has a balance of $900 and it's at an interest rate of 29%. That's killing them with that. Even though it only shows up as a minimum payment of $25, if they can get that paid off with the extra money for right now, that would eliminate that payment and everything. Maintain the capital too. Of course, food is required. There's no cutting back there. Cable internet service. We're also discussing ways to minimize that as well, because obviously the kids are home and you gotta have it. You have to have internet for schooling, and you have to have some kind of. But they have 1, 2, 3, 4 services. We discussed cutting back to the 2 minimal services subscriptions so that they can save money there. Additional $27 if we just cut down the 2 most expensive. Cell phones is a prereq too. I mean, I would almost take out the kids for right now, but I mean, these programs, you can't eliminate that as easily. You know what I mean?
Right.
Your lines and everything. Since everybody's home and everything, require just the mom and dad to have it, if that's possible. We never really got to discussing how the family's coping with financial stress or sacrificing cultural values and everything. So that's as far as we got.
Okay. Well, no, I think that you did a great job. That was one of the heavy hitters in terms of like just content, a lot of information there going on with that. Yeah. But I think it's a good way for you to kind of explore what's weighing on them and the reason why there's some stress there. I like the suggestion of starting with the necessities and going back to our crisis budgeting discussion. These homeowners, we want to make sure we're reaching back out to our homeowners, that they're not afraid to contact their lenders, because their lenders, it's a costly thing to go into the loss mitigation or the foreclosure process. So none of the lenders want that. They all want to be able to have that. And for example, when I spoke to Dark Feather, she was talking about partial claim. They can't even give that option out to someone who didn't make that first connection and communicate with them. So it's not even available unless they contact their lender. So very important. I also like how you applied, evaluating subscriptions. I know I myself, I got 2 boys, and Disney Plus is like my little, babysitter sometimes. And it's true, they need that outlet as well. But then do I need 4 subscriptions? So just talking about that and talking through that is what we want to make sure we're reminding our homeowners to do. Car insurance, homeowners insurance, reevaluating those things to see if you can cut down those costs as well. So great job, Andy, and the rest of the group too. And I think with group 3, what I'd like to do is you kind of got an idea of, well, I'll give you a synopsis of both Miss Chaos and the Mayhem family. So in the Mayhem family's case, the father's mother had COVID, and so he reduced his hours. Miss Mayhem has actually stopped beating. and stopped doing that. She used to do it as additional income. So, they're stressed out from that perspective of just having all of this going on in their family. But in addition to that, Miss Mayhem has looked at, quick options to help them. So there's some predatory lending going on there with the idea that they could maybe sell their home to someone who might be able to let them, rent it back to them. And so I think that this would be very helpful for them to go through that process of talking to their lender, because obviously they're in jeopardy of going down that road, because it seems like an easy fix. But one of the things it talks about in both cases, both Mr. and Mrs. Mayhem, and then Miss Chaos, who's had family come back into her home and she wants to expand her home, as Stephanie mentioned, is the idea that, they may be cutting, they're gaining certain things in terms of helping their family out. Certainly that's priority to them. That's center. And so, Miss Mayhem might want to continue beading because that's what brought her joy, and maybe, can help her think through some of the big questions that she has. And then also to, how can they budget to maybe have an outing? It doesn't necessarily need to be a sporting event or something that used to cost them a lot of money, but maybe they can budget for some sort of outlet so that they can get their family back to feeling more healthy in that mindset. And then for the other folks, I'd like to hear from group 3 to kind of see what they talked about in terms of that last question. So how the family's coping with financial stress, but not necessarily losing or maybe sacrificing in some cases that the core values that they have or their cultural identity.
Group 3 was Amanda, Anna, Michelle, and Anna.
Well, we figured that she would refinance with the no cash out option. Looking at these numbers, she could pay down her credit cards, expand her garage, and then just sitting here listening to you guys, I was thinking she didn't need to take out, because I figured it was like $68,000, and she would have to refinance $188,000. So I don't know. I didn't know how to do those numbers, but in general, that's what I got from that.
This is Anna. Just from listening, because it sounds like they're more on the lender side, all of them. But just from listening from them, and like the cultural values and stuff, it was like she was wanting to take her sister in, but with the group, they really looked at what she could afford. But the more they start talking about it, it wasn't sounding like it was realistic for her to pay on that $120,000 and then taking that money out for her garage and things like that. So it kind of stopped there. But I know, like, going back to those cultural values and stuff like that, trying to take in her sister, add on an addition or extra room for them. So those things came in, and it kind of paused right there about her affordability.
Right. So that was a heavy question, right? Because she does value the fact that it's what she's trying to do is to support that value that she has to bring her family in and redo that room to accommodate, convert the garage, right? But then too, it could mess with her affordability. And she didn't really take advantage of any of the assistance programs prior to the start of COVID, because she just felt like she didn't qualify, right? She was living in the home alone. She could afford to make her payments, so she didn't even attempt to go down those options. So she might want to reevaluate and kind of say, well, before I take money out of my home and look into the equity aspect, maybe I want to see about some of these other options that are available to me. And I think that that's the financial stress element of weighing all of these elements. It's not just the finances, it's the values systems that we're bringing to the table as well. So I think you guys did a great job of evaluating it from both the lender and from the client side of things and asking the right questions. I would say definitely use the checklist, review those documents that I put in the chat area there. And then that way, if you scroll up, you'll see that all of the documents that I referenced and a copy of the presentation is there for you to review as well. And so somebody said that they really wanted a refinancing refresher, which is always a good option because, you know, obviously I'm number shy. Like I plugged in all the numbers to make sure everything worked for the case study. But then when I get in front of a crowd, I tend to freeze up, right? So it's always good to take those types of refresher courses and so that you can play with the numbers and make sure that we're advocating for the right options for our clients. So with that, I'm going to go ahead and toss it back over to Vicki. If you have any questions, you can put them in the chat area. I'll be here to answer them as we go, but I really do appreciate your time and in attending this two-part series.
Let's give Marie a round of applause. Thank you so much, Marie. You did such a fabulous job and a lot of content. So I will be sending the recording link as well as the handouts. But before you all leave, I know that Joanna has an announcement to just mention to folks about some resources. So let's have her hear that. And again, if you guys have any questions, Marie is here. She can circle back. Feel free to email her directly. She's in our last email thread. So you should have her email address. But what I'll do again, like I said, I'll send it out and I'll be sure to have her contact information there. So if you need her for anything, she's happy to help. Thank you again, Marie. Joanna?
Hi guys, great to see everybody. Thanks Vicki and Marie for another great session. And thanks for a couple minutes just to share with you, with folks, a reminder about the Native Homeownership Protection Plan. We know this is a lot of work that, as Marie just said, you know, getting up to speed on how to help your clients navigate through this, through the pandemic and the impact it's had on their finances. And our funders have recognized that, as you know, for those that have participated with the Native Homeownership Protection Plan. The first part, as you know, was relief services, actually dollars to provide relief for your clients who needed it. And now we're looking at how to support your efforts in providing education. So I won't go into all the details here. I know there's been a couple webinars and Leslie's talked and emailed with many of you, but just a reminder, I put a link to the application form that's on the website. I put it in the chat box. I know we've been talking about this and there's no hard deadline, but I just wanted to share that if we don't use these funds, they're going to go back to Fannie Mae. So I would encourage you to take the time to look at your data that you've already been reporting on and look at who you've been serving already, because the funds go back to last summer. But if you have questions, reach out to Leslie. Just, I really encourage you guys to set aside some time with your team, and we need to use the funds and have the paperwork submitted so that you can be reimbursed, so that the coalition can be reimbursed from Fannie Mae. And I see a comment Michelle said, "We were approved. I'm reviewing my data since last summer." This is the Native Homeownership Protection Plan, not the money for your clients, but this is to get reimbursed. And this is not HERO. So it's something different than HERO.
Yep, we submitted my application when Leslie sent it out the other day, and within the day, and here she approved it within hours. So now I'm reviewing all the data. Yeah. So.
Okay. Thank you, Michelle. So basically, the application that you submit approves you as a participant, and then you have to submit the data with your calculations.
Yeah. She sent us that form too.
Okay. So yeah, thank you, Michelle, for saying that, because even if you haven't done your data, you can submit the application to participate in the program, and then you can go back and undo the data and analyze the data and figure out what you can be reimbursed for. So in order to participate, you just have to be current on your dues, you have to be current on your reporting, and so get through all that as the first starting point, and then go back and see how much you can qualify for, because it's unrestricted money that you can use for whatever you'd like to use it for. And so who wouldn't love that?
Joanna,
All right.
this is Anna. I have just one quick question before you go. Does it have to be clients that were helped with previous NHPP funds, or is just clients in general that we helped throughout the pandemic?
All of the above. People that you helped with their finances to preserve home ownership. So it doesn't have to be someone that you helped with NHPP relief. It could be anyone that is encountering financial hardships, and you're helping to provide housing counseling services to them so that they can stay current on their mortgage and, you know, and do all the things that we just talked about today with Marie. Awesome. All right. And you guys, and I'm sure you'll be hearing from Leslie, you know, with more information by email. If you have questions, email her. Talk to Michelle. She's broken the code. Thanks, guys.
I think there's a question here, Joanna. What is the program and where can I get more information so that I can apply for FSST? That's from Andy. Sorry, Andy, I just called you out.
Andy, did you see what I put in the chat box? Yes. It's on the coalition website. So there's a link there in the chat box. Was that what you were asking for, or something else?
We're talking about this, how the program can get reimbursed for what is it exactly?
Counseling services for homeownership preservation. Okay. So there was a webinar last week. Did you see the webinar that Leslie did?
No, I didn't. I was out of town for that one.
Okay, no worries. You guys, if you click on the website, there's a link to all the information. And I know for sure if you want to schedule a call with Leslie to talk to her about it, she'll be happy to do that.
Okay.
Awesome. Thanks, Andy.
You're welcome. Thank you.
Thank you, Andy. So see you all. Our next webinar is on April 28th. And so we'll see you then. Take care, everyone.